Every financial crisis in history opens with the same haunting scene: screens glowing red, headlines screaming panic, and millions of people watching their wealth evaporate in real time. Savings disappear, businesses crumble, dreams collapse overnight. But beneath the chaos, something else is happening, something far quieter, far more powerful, and far more important: a reset. Because every crash, no matter how devastating, clears the field. It ends one financial era and opens the door for a new generation of winners. Old empires fall, and new ones rise from the rubble. This is the paradox of every market cycle. The same force that destroys wealth also creates the greatest opportunities ever seen. And today, all the signs, psychological, structural, political, and economic, are pointing toward a potential correction around 2026. Credit cycles stretched, bond markets flashing warnings, megacap valuations pushed to extremes, retail euphoria climbing higher and faster than logic can support. The stage is being set, not for fear, not for panic, but for the next great transfer of wealth. To understand how crashes create fortunes and why the next one may be closer than we think, we need to walk through the patterns that have repeated for over a century. The cycle of euphoria, complacency, panic, capitulation, and finally, opportunity. This is the moment when the world freezes and a few move, when the crowd sells and a few quietly build their empires. This is the story of those few, and the blueprint of how every market collapse becomes a beginning, not an end.
When markets break, fortunes begin. Crashes destroy wealth, yet they also clear the field for a new generation of winners. This is the paradox at the heart of economic cycles. We must recognize the repeating five-stage cycle: euphoria, complacency, panic, capitulation, and finally, opportunity. Signs point toward a possible market correction around 2026. Examine the signals: historically high debt levels, the bond market's inverted yield curve, and valuation and concentration risk in mega-cap technology companies. The psychology of an inexperienced investing generation, fueled by commission-free trading and social media, adds instability. Political and policy cycles also create structural risk. History shows this mechanism. The Great Depression, dot-com crash, and 2008 crisis all followed this logic. Fortunes are made in the aftermath, requiring emotional discipline. Smart investors prepare by building cash reserves, reducing leverage, focusing on durable companies, and diversifying across asset classes. Adopt a long-term time horizon. By recognizing the rhythm of the cycle, reading the signals, and preparing with discipline, you can position yourself to survive, act, and prosper when the cycle turns.
Third, the bond market is a prophetic signal. An inverted yield curve, where short-term rates exceed long-term rates, has preceded most U.S. recessions over the past half-century. This inversion signals that investors expect weaker growth and lower rates, pricing this expectation into long-term bonds. A sustained inversion is a financial fever, often the first market signal prudent investors heed. Fourth, consider valuation and concentration risk, especially in mega-cap technology companies. Innovation drives wealth, and dominant cloud providers and semiconductor leaders have delivered extraordinary returns. However, when a small set of companies dominates market capitalization, resilience declines. Elevated forward multiples and optimistic growth narratives make valuations vulnerable to disappointment. Bubbles form when price outruns the time it takes for earnings to grow into expectations. When reality is slower than sentiment, corrections often follow. Fifth, the psychology of a new investing generation contributes to instability. Retail participation surged, fueled by commission-free trading and social media. When inexperienced money floods speculative names, it creates sharp rallies that can reverse violently. The rise of short-duration option trading and meme-driven speculation introduces instability. Political and policy cycles interact with markets in predictable ways. Elections change fiscal priorities, regulation, and taxation. Markets react as policy gradients shift. Historically, the first 2 years after a major election can see significant repricing as stimulus policies normalize, tax plans are clarified, and regulatory agendas become actionable. The 2024 election and its aftermath can be seen as a structural input into the 2025 to 2026 risk calendar. Policy transitions, phasing out of pandemic-era supports, or shifts in central bank guidance could all act as catalysts for re-evaluating asset prices. With those broad macro signals understood, we step into history to see the mechanism in action. The Great Depression, the dot-com crash, and the 2008 financial crisis each follow the same logic. Excess rises, the correction arrives, and opportunists buy assets at depressed prices. During the Great Depression, equity markets collapsed, but the lowest prices created the conditions for firms and wealthy investors to acquire assets at fire sale multiples. In the early 2000s, the dot-com rout wiped out speculative internet firms, but survivors and new companies built the next generation of enterprise value. In 2008, the housing market implosion and credit freeze destroyed enormous paper wealth, yet those with liquidity purchased distressed assets at steep discounts. Their patient capital produced outsized gains. These historical lessons shape a central paradox. Fortunes are not made during the mania, they are made in the aftermath. During the boom, everyone wants in. Valuations are high and marginal capital achieves low returns. During the aftermath, fear is high, valuations are low, and patient capital compounds for decades. This is not mere armchair nostalgia, it is empirical. Buyers at the bottoms of major cycles often achieved returns multiple times larger than those of investors who entered at euphoric peaks.
Market crashes are often driven by powerful psychological forces like fear, greed, and denial, rather than purely rational calculations. Investors can fall prey to optimism bias during manias and loss aversion during downturns, leading to panic selling. The most successful investors during crashes exhibit emotional discipline, preparing in calm times and acting decisively when others panic. A key strategy is building substantial cash reserves, often called dry powder. This liquidity provides powerful buying opportunities during significant market downturns. Secondly, reduce or avoid unnecessary leverage. Leverage amplifies both gains and losses, leading to forced sales during market collapses. Focus on durable, profitable companies with competitive advantages and diversified revenue streams, prioritizing balance sheet strength. Adopt dollar cost averaging to mitigate timing risk, deploying capital in tranches as prices decline to smooth the effective purchase price. Finally, diversify across asset classes and geographies. This thoughtful allocation reduces the probability of catastrophic loss and keeps optionality alive. By understanding market psychology and implementing these strategies, investors can build resilient portfolios and navigate corrections effectively.
Building wealth through cycles is not a mechanical algorithm. It is an exercise in temperament. Strategies like accumulating cash, avoiding excessive leverage, and focusing on durable companies are necessary. They must be matched by the courage to act when fear is loud and the patience to hold when the world doubts you. This temperament is rarer than knowledge because it requires mastery over immediate emotion, often in the face of social pressure and public hysteria. Crashes write two stories, one of loss for the many, and one of rebirth and empire building for the few. The few are better prepared, less emotional, and strategically positioned, buying when markets are bleak. They nurture what they buy through years of recovery, compounding wealth when a cycle turns. The alignment of credit cycles, bond market signals, and concentrated valuations creates elevated risk. Those who take this seriously will prepare in ways that make their future optionality larger. Begin with a checklist, establish cash reserves, audit leverage, and identify high-quality companies. Learn distressed asset acquisition, set up rules for capital deployment, and above all, cultivate patience. The greatest wealth transfers followed those who acted prudently at the right phase of the cycle.